John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hello, my name is John Ulzheimer. I am a consumer credit expert. I have spent almost 30 years in the credit industry. Spent some time at FICO, which is the company behind the FICO credit scoring system, and Equifax, which is one of the 3 generally recognized credit reporting agencies in the United States. So today's question actually applies to both primary credit card holders and authorized users. So those people who are added to credit card accounts as being an authorized user, which is a common way that people build credit. I built credit that way almost 3.5 decades ago. So it's actually a pretty common and well-established method for building credit. But the question specifically is does having a credit card closed or just closing a credit card, can that harm my credit? And so the answer to that question, which is a pretty common answer to credit scoring related questions, is it depends. It depends for a variety of reasons. Number one, it depends on the type of credit you have prior to the account being closed. And then number two, it depends on if when the account closed, if the credit card issuer leaves it on the credit report or if they remove it from the credit report. And that's actually really the big one. If you have an account that's in good standing on your credit report, whether you're the primary card holder or an authorized user or a mortgage or an auto loan, it doesn't really matter. If it's in good standing, then there is no legal obligation for the credit reporting agencies or the bank or furnisher to remove it from your credit reports ever. It can stay indefinitely. Now, having said that, it doesn't. The credit reporting agencies currently anyways all have a policy in place whereby they will remove inactive accounts after a decade. So if you close a credit card account, or if a credit card account is closed from underneath you and it's in good standing, then you can really add about 10 years to that date, and that's how long it's going to remain on your credit reports. So when the account is closed, as long as it still remains on your credit report, the age of the account, you're still getting value out of that age of the account. And credit card accounts continue to age even after they're closed. And so if you have a 10-year-old credit card that is closed today, in a year from now, it's going to be an 11-year-old credit card. So even closed, it continues to age. And that's actually the source of a pretty common myth that when you close a credit card account, that you lose the value of the age of the card. That's incorrect. Only if it's removed from the credit report do you lose the value of the age. The other way that closing a credit card account can possibly harm your score is you lose the value of the unused credit limit. There is a metric in both FICO's and Vantage Score's credit scoring systems that's formally referred to as revolving utilization. Some people refer to it as the credit utilization percentage or the balance to limit ratio. It's kind of all the same thing, even though revolving utilization is actually what it's called. And it's the relationship between the balances on your credit cards and the credit limits on your credit cards. And so the lower that ratio, meaning the lower the balance relative to your credit limits, the better that's going to be for your score, because you're going to earn more points in that particular category. There's a myth about that category. There's a lot of myths about credit scores. There's a myth about that category that it's worth 30% of the points in your score. Again, that's factually inaccurate. It's in the category that's worth 30% of the points in your score. It's not the category, meaning that there are a lot of other things in that particular category that make up the 30%. It's not just that revolving utilization ratio. But nonetheless, it's important, and you want to keep that ratio as low as possible. And one of the ways of doing so is to have a whole lot of credit limits that are unused and low balances relative to those limits. And it's actually a pretty easy calculation. All you do is take your balance and divide it by your credit limit, and that's the ratio. So if you have $5,000 of balances on your credit report and $10,000 of limits, 5,000 divided by 10,000 is 0.5, multiply that by 100, and that's 50%. So your utilization ratio in that particular example is 50%. Not great, not horrible. You really want that ratio to be less than 10%. You read a lot of articles, keep it at 30%, wrong. You want to keep it less than 10%, and that way you do well across all credit scoring systems, regardless of if they're built by FICO or Vantage Score. So when you close a credit card account, or if a card is closed out from underneath you, then you lose the value of unused credit limit in that ratio. So if you have a $5,000 unused credit limit and the card becomes closed, then that $5,000 credit limit is not going to be counted in that ratio any longer. And unless you pay down the balance of your other credit cards, your balance to limit ratios are going to go up. That's a mathematical certainty. And if they go up enough, then your credit score is going to start coming down. So that's the real reason why your score can go down if an account is closed. And again, this is applicable if you're the primary card holder or if you're the authorized user. So just because you're the authorized user, don't think that you're immune from this happening to you. And just because you're the primary card holder, again, don't think that you're immune from this happening to you either. It can happen to you regardless. What's really important is how that account changes on your credit report. So to the extent that you can avoid having that happen to you, that's probably good. If you can't avoid that happening, then timing is the real issue. Is you don't want to time that to happen right before you apply for a mortgage or right before you apply for an auto loan, because you don't want your score to go down right before you're applying for some really large dollar loan where every basis point in your interest rate means real money every single month. So hopefully that sheds some light on the issue of credit scoring and closing of cards. If you have any questions, drop them in the comment section below and I'll do my best to get to them. Thanks a lot for watching and have a great rest of your day. We'll talk again soon.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.